Hi guys, welcome to another video. In this one, I want to tell you about a little Canadian company called XCO Technologies, ticker symbol XTC. Now this is actually a dividend paying stock that I hold in my Canadian dividend portfolio. It's one of my core holdings actually in that portfolio. Most of my money is allocated to that core portfolio, and this one is actually a pretty big holding for it. I want to do a video on this stock in particular because I think this one has some catalysts coming up that are probably going to drive the price forward. I think the future for this one looks pretty good over the next year or two, and it's one that I just recently reviewed, and I sort of reassured myself that this is one that looks really good for the next little while. I'm kind of excited about the growth that this one has in store for it. So if you're interested in this kind of thing, in these dividend stocks, passive income, you can check out my larger Canadian portfolio that holds all dividend stocks. It's on my Patreon. And up there on Patreon, I do updates from an income standpoint, the amount of dividend income I'm taking in each month, all of the core holdings and the details. And I will periodically post my thoughts around rebalancing that portfolio, why I'm selling something, why I'm buying something else. So if you're into that kind of thing, it's well worth checking out my Patreon, and you can follow along to everything that I do in my dividend portfolio. But like I said, in this one, I want to tell you about this stock in particular, XTC. Let's get into it. Okay, so XTC, like I said in the intro, they're a small cap Canadian company. They're a strong dividend payer, and basically they're in the business of automotive parts. And so they supply a lot of these small car parts into the big OEMs and the tier one manufacturers. And they're also diversified a little bit into what they call this aluminum extrusion business, where they produce aluminum tooling and small parts and aluminum molds, some of which is for the automotive industry and some of which is diversified a little bit into some other industries. So if we take a look here at the overview slide, they kind of get into that, and they say that a little bit. They're actually a global company. They have 15 plants across 7 countries, 4,800 employees. I like the fact that insiders own 48% of this company, so it's strongly held. I think management is really behind the company here. They're also calling attention here to the fact that they have some growth vectors identified in this market shift to SUVs, the most popular vehicle on the market right now. They're seeing some growth in that segment, and they're also looking forward to some potential growth in the EV market. And in a little bit, I'll get into the specifics of that later on in the video. They're also saying here, they have increased the dividend 12 times in 11 consecutive years. That's a pretty good track record for a dividend-paying stock. It's especially good for a small cap stock, right? This is a rarity where you have a small cap company that has all of the growth characteristics of a small cap, right? They can move faster, they can execute more quickly on these opportunities, they can switch product streams, they can get into new customers, all that kind of stuff. They move fast, but they're also a strong dividend payer, which is really, really great. I think this one is a nice lineup. It gives you the best of both worlds in terms of that steady passive income and also the potential for strong growth and price appreciation. Now, on the automotive side of things, like I said, they make these small parts for cars, so they're actually an industry leader in these kinds of things, these leather-wrapped steering wheels and cargo management solutions like the nets that you have in the back of your car, and those small space dividers, different panels and molded components that are going into the car. So they sell a lot of these interior components that you see inside the car, and they also sell some of the body and frame components as well on the outside of the vehicle. And so, that's one of their growth vectors, is their ability to broaden their product offering into different parts within different types of cars. An OEM is going to come in and say, hey, listen, I got a new model here. I need a different type of shifter knob or steering wheel or whatever it is. And then they're able to respond and grow into that business, which they've had some success with. And, they're already into, basically, as they say here, 15 different OEMs and dozens of other tier one customers all over the world. So they have pretty good market penetration into the folks that they need to sell these things into. And as they say here again, they are looking forward to increased EV exposure in the future. Now, on the diversified side of their business, it's that other market segment, which is this extrusion tooling group, which is really two different things. One is that they can produce these small components out of aluminum, which is kind of unique, right? Because aluminum parts are lighter and they have really good wear characteristics and that kind of thing. So they're able to actually lighten up a lot of industrial applications by creating these aluminum parts through extrusion tooling and selling them into a lot of different industries. So, this is really their way of diversifying the business a little bit. So they're not entirely within the automotive sector, and they've had a little bit of success in that at selling both extruded aluminum components into other markets and also producing these aluminum molds, these injection molds, where other people can then manufacture aluminum components as well. So they're really a key player in this aluminum parts space. So I want to take a look at a company summary here in this tool that I use. It's called Portfolio 123. I basically use it for everything in terms of managing my portfolio, investigating stocks, digging into the details of them, especially in the financial side, and a lot of the quantitative metrics that you need to know before you go and buy a stock. So this is one particular view that I like in Portfolio 123. It sort of gives you this snapshot view of a company. If you're interested in the tool at all, there's a link down in the description to a trial where you can check out Portfolio 123. A lot of what they offer is free. Some of it's paid. So definitely go and check that out. There's some awesome tools in there. Now, on this one here, we have XTC. It gives you a little bit of snapshot, and you can see some really strong price action over the last little while, ever since basically the fall of last year. They've been on a really strong uptrend, and I'll explain why that is in a second. Like I say, they're a small cap Canadian company, market cap under 500 million, which is my definition of a small cap, and they pay a healthy dividend yield. So even at the elevated price where it is right now, they're still yielding 3.67%. So there's a nice healthy passive dividend income that comes along with these guys. If you had managed to buy in back here, either during the crash or shortly afterwards, you were going to get a higher yield. I think, back then you would have gotten up above 5, 6, 7% type of thing, which would have been a really awesome deal for a solid company like this, right? That definitely was a once in a generation opportunity to snap up some quality companies at bargain basement prices. So, if you look at the summary here of their growth rates, the sales have been taking a hit over the last little while. Over the last year, sales definitely took a hit back in 2020. So a lot of these car manufacturers were scaling back the plant capacity, not only because people were not buying vehicles in 2020, dealerships were closed and all this kind of thing, consumer confidence was low, but also because the factories were shut down, shifts were off and that kind of thing. So that really hurt XTC. And so their ability to sell into those channels was almost completely shut down to a degree. And so we see that in the sales numbers. Happily, though, we don't see quite as much of it in the EPS numbers, and I'll get into that down below as well. And even over the last year, trailing 12 months, they've actually managed to increase the dividend. There was just an increase in this quarter, which was really, really nice to see. Nice little pay raise for those of us that hold the stock. If you look over here on the performance metrics, some of the quality metrics, what really stands out for these guys is their ability to generate return on assets, return on equity, return on investment, all well in excess of the industry average, right? So you're looking at return on equity here of over 9%. That's really, really good. Again, it's one of these characteristics of a small cap growth company where you see this real efficiency in terms of their ability to generate that return. It's pretty cool versus a lot of the peers in the industry are much bigger. And so they don't have that same ability to generate the same return on assets and equity. And so, I mentioned the EPS upside, even in 2020, they had a number of surprises to the upside. This is a key thing that I look for in any company. If they're able to consistently surprise to the upside over the last few quarters, there's a really good chance that they're going to be able to continue to do that into the next few quarters. And that's a huge catalyst for the stock price, right? Like anytime you surprise to the upside, people, that'll catch their attention. I think it draws buyers in. It causes analysts to raise their price targets. All kinds of fantastic things happen when a company is able to surprise on earnings. And these guys have a strong history of being able to do that. I think I mentioned the balance sheet previously. And so, what these guys did in 2020 when they had that kind of shutdown is they really went into survival mode, right? They scaled everything back. They looked for efficiencies wherever they could find it. A lot of companies did this. I think that XTC was particularly successful at what they did. What their strategy was to pay down debt. So they really reduced their debt load. They increased liquidity, to prepare for the worst case. And so now coming out of that disaster that was 2020, they're in a really strong position, right? The balance sheet is strong. They've paid down the debt. They have a lot of money in the bank, and this is now positioning them really well for growth. And I think the growth is going to come. I think the demand is rebounding. I think in 2021 and definitely coming into 2022, I believe we're going to see strong consumer confidence. And that is what is really needed for these guys. And for anybody in a cyclical industry like automotive, it's really driven by consumer confidence, right? Do people feel good about their jobs? Do they feel secure enough to make a major purchase like a new vehicle? If they don't, they're going to put that off. They're going to buy used. And the OEMs are going to respond by scaling back production, which is going to hurt a company like XTC. I think the opposite is going to be true in 2021. I think there's pent-up demand for new vehicles coming out of 2020, and XTC is well positioned to scale up and sell additional parts into the manufacturers that are also going to hopefully be able to scale up their business as we come out of the pandemic. Okay, so if we list the catalysts that I think are driving this one forward, that cyclicality of the automotive industry is absolutely one of them, right? So I think we're coming out of a depressed period in terms of the overall economy and consumer confidence, the ability to buy those vehicles. I think we're now coming out of that. I think go forward, we're going to start to rise. We're going to come on the upslope, I guess, off that cyclical industry, which is really good. This is when you want to own cyclical stocks, right? When you're at the bottom and coming up out of that bottom. There's risk in that, obviously, but I think right now there's certainly more upside potential than there is downside risk in terms of that cyclical industry that these guys in particular are a part of. Number two is that I think there is a tailwind for these guys in both segments in terms of electric vehicles. So one of the segments here, obviously, is the auto parts. Electric vehicles are dramatically going to change the cabin layout in a lot of different car models because the nature of the vehicle is different. And especially as we get closer and closer to autonomous driving capability, all of the layouts of those cabins are going to need to change even more, which is going to drive demand into those interior cabin parts suppliers like XTC. I think they're going to be in a position to provide a lot of new products and a lot of modified products into electric vehicles. Not only that, but within casting and extrusion, EVs are going to generate demand for lighter components. So we see this already with internal combustion engine vehicles where there is a demand for lighter components to to increase fuel efficiency and meet these tighter emission standards. So, legacy vehicles are driving demand for aluminum components that XTC makes, and EVs are absolutely driving a need for the same components because EVs need to be lighter in order to increase overall driving range and get the most you possibly can out of the battery, which is a key performance metric for EVs. So I think as we get into broader adoption of electric vehicles, they're going to turn to suppliers like XTC for lighter components and revised components within the cabin. I think both those things are a tailwind for these guys that not everybody particularly sees or understands for this particular company. And I think they're going to be able to recognize some pretty cool growth into the next couple of years and beyond, given what's happening with electric vehicles right now. Next up, I think, is that these guys are going to see profits rebound, and I think that's going to drive an increase in the share price. I think it already has. I think that the market has recognized that the worst is behind XTC. I think they're going to be able to come out of this and really increase the sales that they're making, increase the profit margin, because again, throughout the pandemic, they really cut back on expenses, right? They tightened everything up that they possibly could, and now they're emerging in a stronger position financially. So I think both the increased revenue and the decreased expenses coming out of that particular rough period are going to mean increased profits for the future, and I think that is going to drive the share price even higher than it already has. The last thing here in terms of catalysts is the dividend and the dividend increases that these guys have seen. I'm primarily a dividend investor. I'm a dividend growth investor. So I don't just look for current income. I look for a company that has the potential to give me pay raises every year. I want to make more money on my dividends. And these guys have delivered on this, right? They have a 14% compound growth rate on their dividends going back to 2011, which is really, really strong. If I can see a 9-10% growth rate, I'm super excited about that, let alone 14% consistently over that period. That's really awesome. That is going to drive more buyers into the stock, right? So as a company increases the dividends, people are going to come in and look to buy that income stream. That bids up the share price. So a strong commitment to dividend growth for a company is a really, really good indicator for price appreciation in the company as well. So I think you can have it both in these guys, right? I think you can have a really solid dividend yield, 3.6%. I think you can have solid growth in that dividend. I believe that the growth is going to continue along the same trajectory that it has over the past decade. And I think you're going to see strong increases increases in the price as a result of that. So this is one that I'm excited to hold. I'm looking forward to what the next couple of years have, both in terms of the dividend and the capital appreciation. Okay, so let's look at downside risk for these guys. What concerns me? So number one is the cyclical industry that they're in, right? Extremely vulnerable to an outside shock. And you think about where the market is right now, it's frothy, right? We're at a potential peak in the market. And I think that if any kind of outside shock hits this market, I don't know what it could be. Maybe the Fed decides to ease up on QE. Maybe they get it wrong on inflation. Maybe they raise rates too quickly. Whatever it is, or there's some other shock that we can't see coming, then there is the potential for consumer confidence to take a hit. And if that happens, any company in an automotive industry or any cyclical industry is going to take an immediate hit. And really, nobody can see this kind of thing coming, right? If an outside shock hits this market, it has a long way to fall, given the fact that we're at a potential top. We're in what feels like an overbought condition. Companies like this have further to fall than most, because people are then anticipating, a recession, a bear market, a steep correction. These things are particularly damaging to a cyclical industry company like XTC. The other thing I see here that I don't like so much is these guys are in the middle of a supply chain. I always like to see either a fully integrated company in control of a large part of their own business and a large part of their own supply chain. A middle player in the supply chain like this is vulnerable to their upstream customers and the growth that those customers are capable of, and other limiting factors in the upstream customer growth, right? So if anything happens in a particularly big account to make them scale back production or go in a different direction, it's really outside of XTC's control, and sales and revenue are going to suffer as a result of that, which is particularly damaging to a small cap company. These guys talk about diversification, but they're not really diversified, right? They're really an automotive parts supplier, and any disruption in that upstream customer base is going to be felt really keenly in a small company like XTC. The third thing I'm worried about here is I don't really know what the growth vector is for these guys organically, right? Organic growth is the best growth for a company. You want to know that they can just grow the sales with customers that they already have, because that's the cheapest, easiest, and lowest risk type of growth a company can have. I don't think there's a lot of that left for XTC. I think their market penetration is already probably as far as it's gotten. There's going to be some organic growth, I think, from the OEMs that are going to retool vehicles and introduce new lineups, but that's not as significant as I would like. I think that this may drive XTC to growth by acquisition. I think they may go out to look and acquire other companies, competitors in this space, and that means taking on debt, and it means taking on risk that an acquisition will go bad. They'll get it wrong. They'll pull in a company that doesn't perform well, or that they don't know how to integrate into their own business, and that will cause issues. It's always a risky strategy to grow by acquisition. Okay, guys, that's the story on this one. I hope it's useful. If you're into Canadian dividend stocks, you might want to check out my Patreon. The full holdings of my portfolio are on there. Plus, I post anytime I buy, sell, rebalance, all that kind of thing. So it's an opportunity to basically look over my shoulder as I manage a fairly mature investment portfolio with a lot of these Canadian dividend stocks in there. Plus, I post my penny stock picks in there as well. I do a little bit of light trading in penny stocks, and that's another thing that you can see and learn about on my Patreon. So please throw the video a like. It really helps the channel out. Subscribe, ring the bell, and I'll see you on the next one.